Markets fall, portfolios turn red, and suddenly it feels that risk has increased. But what if I told you what you are seeing is not an increase in risk, it's just volatility? In Signal episode 29, let's break down two concepts that are often conflated and therefore misunderstood: risk and volatility. Welcome back to Signal, where noisy markets meet simple, sharp, and sound insights for long-term investors. Let's start with volatility. Volatility in its simplest form is price movement. Markets go up, volatility. Markets go down, volatility. News changes, prices react, volatility. Earnings announcement surprises, volatility. Interest rate movements, volatility. Currency fluctuations impacting foreign capital flows, volatility. Geopolitical tensions rise, volatility. Investor sentiment shifts from fear to greed or greed to fear, volatility. It's visible, frequent, and it's uncomfortable. While volatility is movement, risk is permanence, the permanent loss of capital. Investing in poor businesses, overpaying for even quality businesses, panic selling during market falls, using excessive leverage, over-concentration in a single theme or sector, ignoring fundamentals and chasing momentum, governance failures and structural disruptions. That's where real risk lies. That's where real damage happens. Volatility is like weather. It changes every day. Whereas risk is like a climate that defines the long-term outcome. You don't change your life because of one rainy day, but you do plan your life based on long-term climate. Over the last few weeks, markets have corrected, prices have moved, sentiment has shifted, and it's time to ask, have the underlying fundamentals changed materially? In most cases, no. What has changed is sentiment, which creates volatility, not risk. Risk is when you overpay and returns don't justify the price. Risk is when you are forced to sell at the wrong time. Risk is when poor decisions turn temporary declines into permanent losses. Because volatility by itself is not a risk. Risk is when the same volatility drives you to make decisions that cause permanent damage to your portfolio. So the real question is, are you reacting to volatility or risk? And this is where most investors make critical mistake. They treat volatility as risk and make decisions that actually create risk. Selling quality business in panic, moving completely into cash, stopping long-term plans. Short-term discomfort leads to long-term damage. Disciplined investors think differently. They understand that volatility is temporary, but bad decisions can cause permanent damage. So instead of reacting, they assess. Has the intrinsic value changed? Has my financial plan or allocation changed? Has my time horizon changed? Have my circumstances changed? Or is this simply a price movement? So the next time when markets test your conviction, ask yourself this question: am I facing volatility or risk? Because the answer to this question can help protect years of compounding. Quoting Howard Marks, the biggest investing errors come not from the factors that are informational or analytical, but from those that are psychological. And that's why it's not the volatility that destroys wealth, it's how we respond to it.